Hello and welcome to Outlook Money's Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Asset Management Limited as part of the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Varsha Jain from Outlook Money and your host for this session. Welcome to another episode in our series. Investors looking to minimize risk often turn to passive mutual funds, which simply track the performance of an index. Smart Beta ETFs represent one such category of passive investment, but they are relatively new in India and possibly not widely known among small retail investors. Unlike traditional ETFs, Smart Beta ETFs combine the features of both active and passive fund management. Our conversation today is around these ETFs. Here to shed light on this topic is Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Mr. Nilesh D. Nayak, Head of Investment Products, Share.Market of PhonePe Wealth. So without delay, let's begin the session. So to start off, Mr. Haria, typically individuals may have some familiarity with ETFs, but Smart Beta ETFs might be a new concept for many. Please decode the term Smart Beta ETFs for our viewers.
Thanks, Varsha. So it is interesting to hear that you said people are familiar with ETFs. Just about a few years back, people probably weren't familiar with ETFs. So it's a good progress we've made as a country and as investment professionals over the last 3-4 years. And I must congratulate Outlook for helping take the smart beta concept to the wide audience. If you look at ETFs per se, as many of you would know, they are nothing. They are simply funds which are basically replicating an underlying benchmark, and those funds are traded on the exchange, much like our stock is exchange. That's basically the concept of ETFs, which is known to most of you. Within ETFs, the popular ETFs in the past have been those which have basically had the large cap names or the mid cap names or the small cap names. So basically market cap based selection of stocks. That was basically the ETF category, which was quite popular: large cap, mid cap, small cap. Then, as we moved along in India, in the equity space itself, banking became a very popular ETF. So, banking has been there for, I think, more than 15 years. In that category or in that chronology, smart beta ETFs have now become popular. Now, what is smart beta ETF? Think of what an active fund manager does, right? Because active funds today account for a large part of India's mutual fund market, where active fund managers are basically deciding the stocks, the selection of sectors, the weightages of those stocks within those sectors, all of it on the basis of their style. Their style could be value, their style could be growth, their style could be quality, their style could be momentum as well. Now, when you look at that aspect and you try to bring in some of those aspects, which are these factors, right? Value, quality, low vol, momentum, and you create on the passive side an index which basically has rules to select the stocks and also the weightages of stocks on the basis of any of these factors, which could be price factors or fundamental factors, as the case may be. You basically create a set of stocks combined together to form a smart beta ETF. Now, what is a smart beta ETF? Again, to simplify, you select the stocks and their weightages on the basis of certain factors. Just to give an example, and I'm sure we will elaborate later, but suppose the factor is low volatility. Then those stocks, which is basically from a defined universe of 100 stocks. So you define the universe as top 100 stocks. Out of top 100 stocks, you pick up 30 stocks which basically have low volatility. You rank them on the basis of low volatility, you select them on the basis of low volatility, and you weight the weights given to each stock is also on the basis of low volatility. So this becomes a factor through which you are selecting those stocks, creating the portfolio, and that portfolio or benchmark becomes the benchmark for the ETF that is there, and that is called the low vol ETF, which then you can trade on the exchange and basically get exposure to the smart beta concept of low vol. That's in a nutshell what a smart beta is. It's the selection and the weightage of the security in a manner which is different from the pure market cap based. And the factors can be momentum, low vol, value, etc. And we'll elaborate about it as we move along. This is the simple concept of smart beta, which is picking up some elements of active management, wherein the stock selection can be on the basis of any of these factors. But the true element of remaining passive in terms of having a benchmark universe, the benchmark's stock selection through the factor, and then the ETF replicating the benchmark, that remains the same. Thank you.
Thank you so much. Now, coming to you, Nilesh. As a smart beta ETFs, Chintan has also mentioned are factor based, and some of the popular ones are momentum, low vol, or value, or alpha. Are there more factors basis which new smart beta can be created?
Yeah, I think if you look at the factors that you just mentioned, right, be it momentum, value, low vol, etc. These are been more popular in our market because these factors have done well, in the recent years. But if you think about global market and look at the factors that are being used, frankly, there are hundreds of factors, that investors are using. Are all of them very relevant? Probably not. In fact, let me, quote this interesting research that, three researchers had conducted, as recently as about 5 years back. This is by Arnott, Harvey, and Markowitz. These were the three researchers who did this study. And what they did was, they looked at the, ticker symbols of listed stocks, right? And looked at the first three letters of, their ticker symbols. And that combination, does it have any relevance for, the investment outcomes? Interestingly, what they found is that, all the stocks which have S, as the third letter in their symbol, if you go long on those stocks, and if you short all the stocks which has U as the third letter in the symbol, the investment outcome is outstanding, right, compared to the broader market. In fact, all the statistical significance of all the numbers that they came up with was also very significant. But the point is that, these, inputs that are going into this, research have very little economic sense or investment sense, right? So just because something is resulting into investment outcome does not mean that, you can use that factor. So net out of all those hundreds of factors, you have maybe five or six which are, emerged as very relevant factors from an investment standpoint. So apart from what you mentioned, which is momentum, value, low value, there are factors like size, yield, there's quality, right? Growth. These are some of the factors which have proved to be, very useful when it comes to investing. Just one more number, like if you look at, some of the evolved markets, like let's say United States, which is much more evolved in terms of smart beta investing. If you look at the top three smart beta strategies in that market, those are actually dividend yield, value, and growth. And these three strategies constitute almost 75% of the total smart beta assets which are there in that market. So yes, there are hundreds of factors, but overall, maybe there are five, six, seven, which are more relevant, and some of which are already getting played out in our market.
Okay, thanks for clarifying that. So, Chintan, is multi-factor ETF advisable over a single factor? What should be the better strategy according to you? Investment in one factor or two factor or even more?
So it depends on what combination of factors you are choosing. So let's take the example of, on the one hand, low vol, and on the other hand, momentum. So as we know, momentum benchmark or momentum index is selection of 6-month, 12-month best performing stocks from a universe of 200 stocks. And if you basically pick up that momentum index, you are likely to see higher risk, higher return, and so the return profile and the risk profile is different. Compare that with a low vol, where we've already explained that you have stable stocks which probably have a low risk, low return profile. Now, if you combine low vol and momentum together, then you have basically two factors which probably balance each other out and provide an outcome which is more attuned to what investors would like. It's called the alpha low vol, where you have low volatility as 50% of the factor, and alpha, which is in some sense those stocks which have done well over the last 6 to 12 months, as 50% of the factor. So alpha low vol is selection of two factors together. So that kind of works well for investors looking at a moderate risk return profile. If you're looking at a low risk return profile, then a single factor like low vol will work. So what factors you combine will ultimately determine the outcome. And like Nilesh was mentioning, there are multiple factors which can be put together. How you piece them together, like for example, the value or the value 20 index, which is there you have the four combination of return on capital employed, price to earnings, price to book, and dividend yield combined together in the 40/30/20/10 ratio. uh, Four factors which are basically fundamental factors put together in a particular ratio, and that basically is four factors put together, which basically is allowing investors the access to four factors in one particular investment universe. So that has also actually done well in the past. But what fits an investor will ultimately determine by the fact that in the investor's risk return metric and asset allocation metric, what is it that the investor is trying to achieve? The options are all there. You can have quality, momentum, low vol, etc. But what you choose will be determined by what is it that you need to fit in your portfolio based on your own risk profile. So I'd say that multiple factors work well. There are many permutations, combinations of multiple factors which are possible. In India, currently, we have limited number of multi-factor ETFs, but yes, you can select combination of ETFs which are single factor ETFs and create your own set of combination of multi-factor. And if you choose and put everything together, probably you'll end up getting market beta, which is not the objective. So don't have too many factors, which basically will end up being multi-factor, which will be end up giving you market returns or market beta. But having a thoughtful selection, and obviously, as we all know, that Smart beta as a concept is something which is difficult to understand. We're trying to make it simple, but you must have a financial advisor to handhold you in your overall investments at all points of time, because finance is not something which one learns or is taught that efficiently, and it needs a lot of input from your time in terms of understanding it. So if you really don't have the time, please consult your financial advisor or whoever is advising you on your investments, and then pick and choose whether it's a single factor or multi-factor. But as we see it, all the options are there, and multi-factor has worked, especially the alpha low wall as a combination has worked for most investors who are in the moderate risk return category. Thank you.
Thank you so much. As you said that it is the risk profile and based on which investor has to decide which smart beta fund to invest in. So Nilesh, my next question is from you. What are the risks involved in a smart beta ETFs, and are they riskier than the other passive ETFs?
Yeah, Varsha, I think that's a good question because when it comes to investing, very often we tend to ignore risk, right? Everyone knows that, you need to track performance, returns, etc. So, but having said that, I think there is a myth that passive is less risky compared to active, right? So I'll give an example. For example, if you look at, let's say, Nifty 50 ETF versus an active large cap fund, there is no evidence to show that active large cap will be more risky than Nifty 50 ETF. Likewise, you will have a sector ETF, right, tracking a specific sector. Probably that is more risky than a single factor smart beta strategy like a value factor strategy. So there is no correlation between passive and low risk, or the way you invest, passive versus active, that doesn't determine the risk. What determines the risk is where you are investing, right? And that's very, very important to understand. So you may have a passive strategy which is more risky compared to smart beta, like I said in the two examples that I mentioned. So like Chintan also mentioned, when you combine two or three factors, overall risk tends to go down, and that can be significantly lower risk compared to a sector ETF or some other ETFs, passive ETFs, which are tracking a specific sector or a theme.
All right. Okay. So Chintan, could you tell us whether smart beta ETFs are better in comparison with passive ETFs in terms of expenses and returns?
So I think in general, ETFs in India in terms of expenses, much like all mutual funds, are controlled in terms of how much they can charge, and generally ETFs being low cost are across the board quite efficient for investors to take an exposure to the market. So be it traditional ETFs or smart beta ETFs, I don't think expense ratio is going to be a challenge. So that's something which the investor should not consider. However, what the investor should consider is that yes, smart beta concepts, especially in a market like the last 3 to 4 years, where broad market has done quite better compared to the narrow market of large cap universe, right? So in India, if we see because of the broader market rally, and in general, most sectors in India are doing well over the last 3, 4 years, there's been a broader market rally. And in that broader market rally, if the smart beta universe is wider and you're getting a set of stocks which have done well within that, either because of price performance or value, based on the factors you're choosing those winners within that factor, you actually ended up getting a good experience relative to the traditional large cap ETF. So to that extent, yes, smart beta ETFs have a place in your portfolio. The only thing which I'd like to say is when you're creating an asset allocation plan, you will have a mix of active, passive, gold within financial investments. And within the passive universe and active universe, of course, in the active space, you'll have balance advantage fund category, you'll have a flexi cap category, maybe value, special situations, mid cap, small cap theme, etc. So in active, you'll create a portfolio. In the passive as well, we believe that there are so many options in India available today, wherein instead of having the traditional ETFs, you can choose to have the smart beta ETFs. And if you select the smart beta ETFs in the right manner, you do tend to have an edge in terms of creating a better wealth over the next 5, 10 years. So if you select the right smart beta ETFs, I do believe there is a chance that you may be able to do a slightly better job to your overall wealth creation compared to the traditional ETFs. But then in India, the good part is at least market beta is also going to be good, and the smart betas are also probably going to add value. So what you choose is ultimately going to determine where you make your money. And I think again, just to repeat, a combination of low vol and smart momentum, which is alpha low vol, can be looked at for most investors who are in the moderate risk return category. If you're a conservative investor, then definitely you should tilt towards the low vol index. And if you are an aggressive investor, you should tilt towards the momentum index. So between these three, you actually have quite a good option of combination depending on your risk profile. Thank you.
All right. Now I want to know from you, Nilesh, should an investor consider liquidity also in case of a smart beta ETFs because these are relatively new in India? And can one depend on these for any emergency purpose?
Yeah, I think Varsha, liquidity is important in any investment for that matter. So before investing, one needs to look at liquidity aspect. Uh, by its very nature, being an ETF, typically you tend to be little more liquid because at any point of time, you can sell, your holdings on the exchange. Having said that, I think, like you said, smart beta is a relatively new concept. So it's important to, assess the liquidity of a particular ETF that you are investing, whether there are enough, volumes in the market, to be able to sell. Right, and that becomes very important, and it's not very generic saying that okay, all smart beta ETFs are liquid or illiquid. It varies from one smart beta ETF to another. So it's very important to evaluate that. But the word that you used, emergency, right? I would say that uh, a lot of people invest for emergency needs. Equity product or a smart beta ETF product is not meant for that, right? When you invest into equity, you need to have time on your hands, right? For all your emergency need, it is important to look at right set of product, which is probably a liquid fund or even a bank FD. But from an overall liquidity perspective, yes, it is important to look at what kind of volumes are happening in a particular ETF before you invest into those.
Right. So these can be used in emergency. These are relatively liquid also, so that should not be a concern depending on what smart beta ETF one is investing in. But yes, rightly said, for emergency purposes, one should not go for these, but for FDs and other liquid instruments. Okay. So Chintan, please tell us who are these ETFs useful for, and should someone with no market knowledge start mutual fund investment with these funds?
Sure. So I think a large part of the Indian audience today is aware of what these indices are or what these ETFs are and how they fit in. Whether you are a new investor, we've seen typically new investors, and traditionally we used to say, start your investments with the balance advantage fund category. Now, basically, we are saying that if you want market beta, start your investments with the traditional large cap ETF. So, if you're a beginner, you would typically start with the traditional large cap ETFs, and then as you understand it more, you can move on. To that, now we're basically saying that if you're a new investor, why not start with the low wall, which is the conservative option within the smart beta. So you can start building your journey with the low wall. And as you understand the concepts of smart beta a lot more, you can increase your risk profile in order to improve your return profile for the smart beta concept. So I think the well-established, knowledgeable investors, anyways, are taking advantage of the smart beta ETFs which are available today since they have a better knowledge. But if someone is starting off new, then yes, you may want to start off with the traditional beta, which is the large cap ETFs, or the low vol to start with. And then as you gain more knowledge, you can increase. Smart beta ETFs, as the name suggests, different risk return profiles are available. We already discussed them. And so, be it a beginner, be it someone who's just about learning and has a 3-4 years experience of investing in markets, or a seasoned investor, there is something on offer for all kinds of investors within the smart beta bouquet. And the good news is that almost all AMCs which are in the passive business are looking to expand that in terms of the offerings that are available for investors to invest in. So I do think that smart beta ETFs in particular and ETFs in general are capable of building a portfolio, well-rounded portfolio for all kinds of investors, irrespective of their experience, irrespective of their corpus. The only thing, of course, as Nilesh had also mentioned, you need to have at least a 5-year horizon when you're investing in equities. Don't think of equities as a 2-month, 3-month investment return kind of a product. Most people tend to make that mistake of investing in equities for quick returns, while actually it's the patience which pays in the long run as far as equities is concerned, especially for those who are not watching markets day to day, right? So if you're not a watcher of markets, or if you're not very active in markets, for you to basically invest when the markets are doing well and then take out money when the markets are doing badly would be the general trend which happens. To avoid that, have a long-term view in the markets, have a more than 5-year view, and only that money which you don't need for next 5 years, at least given where market conditions are right now, you should invest in smart beta ETFs to build a portfolio, to create wealth, and more importantly, to probably have a more peaceful investment journey. Because the moment you have goals which you need to fulfill in 2 years' time, 1 year time, and you need to take out money at that point of time, if markets are low, you may end up getting hurt. So all I'd like to say is smart beta ETFs are for everyone, just that you need to have a time horizon in mind. And if you have time horizon in mind, you very well can have a good portfolio created out of the smart beta ETFs. Thank you.
Rightly said, you should have at least 5 years for the investment in equities, be it smart beta ETFs or some other ETFs. Now, here's my last question, Nilesh. Isn't it a little technical concept for a non-finance background person to understand and choose one suitable smart beta ETF? Because do you think this investment option requires handholding? Like Chintan also said that if somebody does not know, then go to advisors and ask for the different options and they can suggest better.
Correct. I believe that, most of the capital market products, when investors are investing, for large, majority of investors, there is, some handholding required, be it in the form of proper advice, education, assistance, whatever you call it. The problem is that, there's a perception that certain products are simple, easy to understand versus some other products being complex, right? Smart beta in some form or other was, I wouldn't say smart beta, but the factors were there in the market, right? We have had value funds in the market for a very long time. Growth funds, for example, dividend yield funds, all those were available, right? And probably people understand them much better compared to smart beta. And I think, in finance or investments, these jargons also make it little difficult for, investors to sort of understand this. But you know the thing is that when it comes to investment product, it is not a tangible product. So for example, if you were to buy a pair of jeans or a t-shirt, right, when you look at the product, you would know the quality of the product, what you can expect, not expect. These days, even if you order something from an e-commerce platform, you have an option to return it back, right? But the issue with the investment product is that you will only get to know probably 3 or 5 years down the line whether your investment decision was right or wrong. So the point that I'm trying to make is, even when people think that certain products are very simple, the classic case today is small cap funds, right? There's huge money coming into small cap funds today. Does that mean all the investors who are investing in small cap funds, they understand small cap investing really well? Probably not, right? So it's important to understand that any capital market or most of the capital market products, when an investor is investing, if you are not completely familiar, it is important to rely on either advisor or at least some sort of education or assistance, that you need to take from experts. In fact, we at Share Market focus a lot on this. And talking about Smart Beta in particular, we have a research team, which is vastly experienced in factor-based investing, etc. And we have been taking initiatives to educate investors, simplify factor investing or Smart Beta investing, and that's very, very critical according to me, not just for this particular product, but across the capital market product spectrum.
Thank you. And very interestingly, you have put it that like we go and buy other things, we cannot go for financial instruments because we only get to know about the return and all after a long period. So we can definitely approach the advisors and the experts who have a good know-how on this. Thank you so much, both of you, for clarifying this. And with this, Investment Made Easy webinar comes to an end. Thank you, Mr. Harya and Mr. Nayak, for joining us today and sharing your insights. Viewers, we trust you found the discussion engaging and enjoyed the session. Please don't forget to like, share, and subscribe our channel to stay connected and informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. We'll be back with our next episode soon. Until then, stay safe, stay active, and stay informed.
Mutual